Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Louis, and I'm excited to share today's top story with you. We're starting off with a look at the latest economic indicators, and it seems like inflation might be making a comeback. The U.S. Producer Price Index jumped 0.9% in July, surpassing expectations and suggesting that inflation could be on the rise. This news has sent shockwaves through the markets, with stock index futures dipping and Treasury yields edging up. Now, let's take a closer look at what this means for investors. On one hand, a surge in producer prices could indicate that the economy is heating up, which might be good news for stocks. On the other hand, it could also mean that the Federal Reserve will be less likely to cut interest rates, which could have a negative impact on the market. We've got some expert analysis coming in from around the globe. Michael Brown, senior research strategist at Pepperstone, says that the PPI data is just a knee-jerk hawkish reaction, and that the market is still expecting a rate cut in September. Meanwhile, Brian Jacobson, chief economist at Annex Wealth Management, notes that the details of the PPI report are where the action is, and that distributors might be using tariffs as a cover to justify price increases. It's clear that there are different opinions on what this data means for the economy and the markets. As always, we'll be keeping a close eye on developments and bringing you the latest insights and analysis. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the latest news that's impacting the world of finance and beyond. In this segment, we're going to explore two significant stories that caught our attention. First, let's look at the situation between the European Union and the United States regarding tariffs. The EU has been dealing with the aftermath of U.S. tariffs on various goods, and now it seems like companies are starting to feel the squeeze. According to a report from the Bureau of Labor Statistics, U.S. wholesale inflation accelerated in July by the most in 3 years, suggesting that companies are passing along higher import costs related to these tariffs. On one hand, this increase in producer prices could be seen as a natural response to the tariffs imposed by the U.S. government. Companies may need to adjust their pricing strategies to maintain profitability in the face of rising costs. However, on the other hand, this could also lead to higher prices for consumers, which might impact demand and ultimately affect economic growth. In another development, the European Union is facing its own set of challenges. The EU has been at odds with the US over trade policies, and it seems like this tension is having a ripple effect on the global economy. A separate report indicates that the Producer Price Index increased 0.9% from a month earlier, with services costs rising by 1.1%, the most since March 2022. It's essential to consider multiple perspectives when evaluating these stories. While some might argue that tariffs are necessary for protecting domestic industries, others claim that they can lead to unintended consequences, such as higher prices and reduced economic growth. As we continue to monitor these developments, it's crucial to remain informed and adapt to the changing landscape. In conclusion, these stories highlight the complexities of global trade and the potential risks associated with tariffs and inflation. As investors and risk managers, it's vital to stay up to date on these developments and consider their potential impact on our portfolios and strategies. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic conversation so far, exploring the intricacies of risk management and investment strategies. As we wrap up today's episode, I'd like to shift our focus to some exciting developments in the tech industry. You may have heard that Intel's CEO, Lip-Bu Tan, recently met with President Donald Trump, sparking a significant surge in the company's stock price. This meeting comes on the heels of Trump's previous demands for Tan's resignation due to his investments in Chinese firms. However, it seems that the two have put their differences aside, at least for now. Intel's shares have been on a roller coaster ride, with some analysts predicting a potential 6% rally from current levels. The stock has already gained around 9% so far this year, roughly in line with the S&P 500's performance. As investors continue to assess TAN's strategic moves, including divesting assets and reallocating resources, it's essential to keep an eye on key price levels. From a technical analysis perspective, Intel's chart shows that the stock has broken down from an ascending channel and retraced to a multi-month trading floor. The shares have since found buying interest around this crucial location and are now moving higher. Investors should watch overhead areas around 22, 24, and 26, as well as a major support level near 19. It's also worth noting that AI chip giants, NVIDIA and Advanced Micro Devices, have agreed to pay 15% of their China chip revenues to the U.S. government in exchange for export licenses. This development could have significant implications for the tech industry as a whole. As we consider these developments, it's essential to remain fair and balanced in our analysis. While some investors may be bullish on Intel's prospects, others may be more cautious. It's crucial to weigh the potential risks and rewards before making any investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.